Welcome back, traders. Before we dive in, make sure to hit that subscribe button and turn on notifications so you never miss these high-value trading psychology insights that can completely change the way you approach the market. Today, we're addressing a frustrating but extremely common problem that silently drains profits from both beginner and intermediate traders: selling winners too early. If you've ever watched a trade soar after you exited or said to yourself, "Why didn't I just let it ride?" then this session is made specifically for you. By the end of this video, you'll understand the deep psychological reasons behind premature exits and have actionable strategies to stop it immediately. The first key point to understand is that selling winners too early is almost never a technical issue. It's not about indicators, charts, or strategy. It's all in the brain. Your mind is wired to seek rewards quickly. When a trade becomes profitable, even slightly, your brain experiences a surge of dopamine, a chemical reward that feels good. That reward triggers a subtle but powerful mental response. The voice that whispers, "Lock it in now, don't get greedy." This is your limbic system taking over, prioritizing immediate gratification over long-term gain. Almost every trader, consciously or unconsciously, falls into this trap at least once, and repeated behavior solidifies this pattern over time. One of the primary behavioral patterns causing early exits is anticipatory anxiety. The moment your trade turns green, the mind starts generating what-if scenarios. What if the market reverses? What if news hits and your profit evaporates in seconds? What if you lose the gains you've just made? The prefrontal cortex, which is responsible for rational decision-making, gets overpowered by the limbic system's emotional circuits. That's why even traders with years of experience suddenly feel panic and sell prematurely, because the brain is trying to protect you from perceived danger. Next, we have reward ratio myopia. This is when your brain evaluates a small gain as a safe victory, regardless of the trade's true potential. Imagine entering a trade expecting a 3-to-1 risk-to-reward ratio. A momentary green candle spikes your profit 0.5x. Your mind immediately categorizes it as enough and triggers a selling impulse. What most traders don't realize is that the early exit interrupts the compounding effect of letting winners run, which is exactly how consistent traders maximize profits over time. Professional traders counter this by employing predefined exit strategies that are anchored in rules, not emotions. This is where the power of planning meets behavioral science. Before entering a trade, they decide on their exit conditions based on objective data, technical levels, risk-reward ratios, or trailing stops. By externalizing the decision-making process, the brain no longer needs to wrestle with emotion mid-trade. The hand follows the plan, not the emotional impulses. A simple technique is visual cue anchoring. The trader writes down exactly under what circumstances they will exit. When the trade turns profitable, the brain already knows what to do, eliminating impulsive exits. Another secret is micro-awareness during trade execution. High-performing traders build in tiny mental checkpoints. Every few minutes or at every profit milestone, they pause and ask, "Am I feeling anxious? Am I reacting to fear or FOMO?" This brief self-check interrupts automatic selling behavior, allowing decisions to remain aligned with pre-planned objectives rather than emotional reactions. Over time, these micro-awareness habits train the brain to separate genuine market signals from impulsive urges. Progressive risk management is also crucial. Professionals often use partial profit-taking and dynamic stop adjustments. This allows them to secure some gains without closing the entire position. For example, locking in 30% of profits while leaving the remaining position to ride according to market movement satisfies the brain's need for reward while still allowing upside potential. This is one of the most effective ways to bridge the gap between emotional comfort and rational decision-making. Behavioral conditioning plays an enormous role as well. If you have historically sold winners too early, your brain has formed a habit loop. Profit appears, anxiety rises, premature sale, temporary relief, dopamine reward. Repeatedly following this loop strengthens the behavior over time. To break this cycle, traders need to retrain the brain using controlled repetition. Paper trading, scaled positions, and simulation exercises allow you to practice letting winners run without the real money emotional stress, rewiring the habit loop over weeks and months. Another overlooked factor is mental visualization prior to market hours. Successful traders spend a few minutes visualizing scenarios where profits grow, spike, and then pull back. This mental rehearsal conditions the limbic system to expect volatility and reduces the brain's tendency to panic when real profits appear. Essentially, your mind becomes familiar with market swings before your capital is at risk, so emotional hijacks are minimized. The interplay between fear and greed cannot be understated. Fear compels you to exit winners too early. Greed tempts you to hold losing trades far too long. Both impulses originate from the same emotional circuitry. The solution is metacognition, thinking about how you think during trades. By recognizing early signs of panic or greed-driven impulses, and by having predefined mental anchors, traders can systematically separate emotion from decision-making. Another advanced technique is trigger-based habit reinforcement. Pros tie specific behaviors to market events. A candlestick hitting a key resistance triggers a calm microbreath. A trailing stop being hit triggers a mental review instead of immediate panic. By anchoring behaviors to repeatable signals rather than emotional reactions, the mind gradually automates rational trading responses and bypasses impulsive decision-making entirely. Post-trade reflection is where the compounding effect occurs. Top traders not only evaluate profits and losses, but also analyze behavior. Did they act according to plan? Did fear or greed influence a decision? Did they maintain discipline at key profit milestones? This reflection strengthens neural pathways for rational behavior and gradually overrides instinctive panic exits. Implementing these layers, predefined exits, emotional checkpoints, partial profit-taking, habit retraining, visualization, trigger-based behavior, and reflective evaluation, builds a system where your brain actively works for you, rather than against you. With consistent practice, you'll see fewer premature exits, higher average profits per trade, and a calmer, more confident approach to the market. Remember, the goal is not to eliminate emotion. That's impossible, but to channel it into a structured, repeatable system. This is the hallmark of consistently profitable traders. Emotions exist, but they don't dictate decisions. You control the outcome. Your brain supports the plan. So, if you're ready to stop leaving money on the table, start implementing these habits today. Like this video if you found it valuable, comment your biggest struggle with holding winners, subscribe to stay updated with high-value trading psychology content, and check out the other videos in this series to continue building a disciplined, profitable mindset. Your next trade deserves the strategy, mindset, and control that consistently profitable traders use every single day.